When will we return to the days of easy money? And could Chinese currency dethrone the dollar? Joining me now to answer these questions and more, Franklin Templeton Fixed Income CIO Sonal Desai. Sonal, thanks so much for coming on the show. We appreciate it.
Thank you, Jack.
So let's start with Friday's jobs report. What was your biggest takeaway?
Look, the labor market's strong. I know that from a market perspective, I hate saying this, but most markets would actually have preferred a slightly weaker number. The labor market is strong. The American consumer is strong, and the labor market is an excellent way to gauge how long the strength of this recovery, and yes, we are still recovering, will continue. So I take away from this that it puts the Fed in a very difficult position. On balance, I don't think they're going to raise, but it makes even more clear that they're on a pause. They're not at a stop. This is not the end of the hiking cycle if they don't raise next week.
So that's an interesting question. And of course, there's a lot of discussion. When do they hike? When do they cut, et cetera? But you're looking at the forest, not the trees. You have pointed out that this easy money we've gotten used to over the past decade may not be here for much longer, or we may not see it for a while, I should say. Can you explain that?
So yeah, we in the markets are so focused on the next rate hike. I've lost count of how many times people ask me, what is the peak? It's not the peak that's interesting. It's the valley. The point is, at some point, the US will face a slowdown, a recession. At some point, the Fed will cut. I happen to think that's not happening this year. But the more interesting thing is, where does the Fed cut to? There are many, many people who think we're going to go back to pre-COVID. And I think that we're really going back to pre-GFC. The aberration, if you will, was not COVID. The aberration was not the post-global financial crisis period where interest rates were really, really low. Or rather the opposite. Let me put it this way. That was the aberration. The fact that we had rates as low as they were for the last 15 years. If I look at where the Fed thinks the normal rate the neutral rate for interest rates is, it's 2.25, 2.5%. I don't think that's right. If I look at what academics, serious studies look at for decades, going back to the 50s, going back centuries, the neutral rate of interest is actually around 2.25. Add in inflation, neutral Fed funds should actually be over 4%. It shouldn't be as low as what the Fed is currently programming.
Yeah, I don't think people realize that literally the past 10 years were some of the lowest rates in 3,000 years, according to a Bank of America study. Okay, what does this mean for portfolios? How should investors set up for this?
I think what investors need to do is to recognize that we should stop looking for equity-like returns from fixed income. Fixed income, I hate saying this, it's supposed to be a boring asset class. You're supposed to get not equity-like returns, and you're not supposed to get equity-like volatility. That has not been the case so far this year. But going further forward, I would hope it does once again begin to be the case, that you look at returns where, yes, I think rates are going to go higher, including in 10-year treasuries. And then we don't see that jump in, because if you blink, you're going to miss it, getting into duration. You go through an extended period of time where rates grind lower as the economy weakens. How do you position for a period like this? Well, you look at interesting places. I like investment grade still. I don't like getting over my skis on risk. Yes, we like high yield, but very actively, specifically picked. We like muni bonds. We think this is a good area to be because, especially in the environment, the fiscal environment we're in today, we think municipals offer value still.
And in fact, you are a member of the esteemed Barron's Roundtable of money managers, portfolio managers, and the Franklin Templeton High Income, or I should say high yield, Municipal Bond Fund was one of your picks. Unfortunately, we have to leave it there. I do want to say that you have some interesting thoughts on how the Chinese renminbi will, in fact, not replace the dollar as the reserve currency. We're going to have you back on to talk about that. Sonal, great to see you again. Thanks so much for coming on the show.